The Treasury market is screaming recession is coming. Oh boy. Okay, we're going to react to that video and give my opinion on this one here today. And then second video I want to react to that I'm looking very forward to watching is the consumer really as strong as Black Friday sales suggest? And I want to dive into that one, which I think that's a big subject. I think that's an important subject we got to discuss because we saw a record number in terms of amount of money spent online on Black Friday. If you went into the real world, you saw it was insanely busy. Like I was in Arizona, I'd never seen Black Friday that busy. It was out of control, like literally out of control. In terms of the malls, I went to several different malls. I went to several different stores. It was out of control busy. And I was like, what the heck? Like I thought the consumer was in a horrible space. Like what are all these people doing out spending money like crazy? And I've also had a ton of people reach out that live in different parts of the country that said, yeah, I went out there too. It was insane. I had folks reach out that live in Texas, folks that reach out that live in the South, folks that reach out that live kind of, let's just call it on the upper East Coast. And they all said it was insanely busy out there as well. The only folks I've heard that said it wasn't that busy out there in the real world was some folks I know that live in California. So I don't want to speak to whatever is going on or not going on in California. But regardless of that, like it was very surprising Black Friday. All this inflation, all the consumers in a bad spot, savings at such low rates, and yet it was out of control. Out of control. This was a year that you thought, man, it has to be down. So yeah, hope you guys enjoyed today's video. As always, appreciate you joining me. I'd love to hear your opinion on either of these videos we react to here today and what your opinion is on either subject. Also, thank you everybody. Thank you everybody that subscribed to the channel. 19,500 plus subscribers now at this point in time. I appreciate each and every one of you. Let's get into this.
I want to get your take on the levels we're seeing here and the fact that we have been in the midst of this bear market rally. Not only near term, what do you think? Where do you think this positions us to finish out the year? But how does this set you up looking to 2023?
We had been calling for a rally from the mid to upper 3,000s on the S&P 500 to about 4,300 by April 30th of 2023. The end of roughly the end of seasonal strength as well. But consider this: the S&P 500 in real terms, inflation adjusted, fell 32% from December 28th of 21 to the intraday low, October 13th, on that bad CPI print.
That's interesting. You don't hear that talked about very often. Inflation-adjusted return for the market. Interesting. Yeah, and technically if you did factor in inflation, then, you know, from peak to trough, it was like 32%.
Average of all 13 bear markets associated with recessions since World War II. So those who are turning bearish or still very bearish, it's a little late in that game. We've already discounted quite a bit of bad news, and right now we're just pausing, I think, at this 200-day moving average in real and nominal terms for the S&P, and also the dollar is having some difficulty going through its 200-day.
It's funny he brings up 200-day. I literally just got done going through Discord DMs right now in my private stock group, and somebody was basically talking about 200-day moving average on a bunch of different stocks and their opinion and stuff like that. So it's just funny. I was reading that, and then this gentleman's like, 200-day moving average.
Okay. I want to bring in Rockefeller Global Family Office CIO Jimmy Chang to this conversation as well. Jimmy, the relationship between treasuries and equities right now seems to be a different narrative emerging from both of these markets. How do you see it?
Yeah, I think these are two very different stories. Equity market seems to be saying that as soon as we get the pivot, it will be followed by a soft landing, then its happy days are here again. But when you look at the treasury market, we have the most inverted yield curve, the 2s and 10s, at minus 80 basis points. This is the most inverted since 1982. Even the 3-month, 10-year, inversion is now about 60 basis points. So the treasury market is screaming recessions coming, and I do side with the, with the fixed income market. If you look at various indicators, from the rapidly falling new orders indices with various Fed surveys to the decline in the housing market, I think we're set up for a 2023 recession.
Ooh, okay. So that's interesting. So a few factors there that I think we have to all think about as investors, right? In terms of this 2023 recession, in terms of the divergence between what's going on in the treasury markets versus stock market. And there's always a good saying that obviously, when there's an inversion, it always predicts recession, right? And this happened in 2019, and then obviously we had a major recession in 2020. But some folks look at that and they say, well, that was caused by Rona. Did the stock market predict that Rona was going to happen? And I think that's fair, but you could also say, like, maybe the recession would have happened regardless of Rona, right? So there's always like this back and forth. But nonetheless, generally speaking, when you get an inversion in the yield curve, it always predicts a recession, essentially, right? And in the stock market, here's the issue, okay? Here's the big issue. In terms of earnings haven't fallen apart for the S&P 500. They've held up pretty darn well. Also, in terms of, if you look at construction data, there's a record amount of homes being built, record amount of apartments, condos, warehouse space, all these sorts of things, right? So it gives an illusion of underlying strength in the economy. Little do you know, when you dig a little deeper, you realize all these projects were all like formulated and started in 2020, 2021, and they just happen to be still being worked on, right? So it's really like more of looking at the past than the future. That's my opinion on that, right? As well as kind of the data proves that as well. So you have a stock market that's very confused. And so the stock market's trying to figure out, and I think that's why we're a little bit in no man's land recently, of like, what's reality? Are we actually going to have this major recession? If we have a major recession, how major are we talking? Are we talking unemployment 5%, 7%, 8%, 9%, 10%, right? What does it mean for GDP? What does it mean for company earnings? Are we talking about S&P 500 earnings would fall like 30% for a year, or 20%, or 10%, or 5%, or stay flat? And so there's so many question marks that the stock market can't jump to too big of conclusions on either side. It can't go to all-time highs right now because there's still that looming out. At the same time, it can't really like crash a bunch more because we don't have any proof. So until we get proof that unemployment starts climbing and mass layoffs happen, I'm not talking about, oh, this company laid off 10,000 employees. I'm talking about hundreds of thousands of jobs being lost or millions of jobs being lost in a month. That's mass layoffs. Until you get that, the stock market's going to continue to be in this no man's land of like trying to figure out, well, are we in a 2007 moment right now, or are we not, right? And so that's where the market's very, very confused right now. And so I'm just very understanding of that. And if you're a long-term investor, sometimes these markets are best because you're able to build out positions in companies that you love at discounted rates and do it over a pretty sustainable amount of time, right? So let's say, for instance, you love NVIDIA stock, right? And you love currently the valuation NVIDIA is sitting at, right? And so you're able to start buying that position over the next few months, and maybe NVIDIA trades down a little bit from here, right? Let's say we get a major recession, NVIDIA earnings fall a lot more, and let's say the stock falls another 20, 30%. Well, you're able to pick up those shares at a very cheap rate for pretty much like the next year to year and a half, if you get that sort of opportunity, right? As a long-term investor, that's pretty darn interesting, right? And in almost any other normal economic environment, you don't get that sort of long time period to get it to buy a quality stock like that at a very big discount. And the same for that NVIDIA example, I could go through 20 other stocks that would fit that criteria as well. It's like very profitable companies, great balance sheets, great leadership, great management teams, great board of directors, great product lines and services that the companies sell, right? And so, you know, as a long-term investor, it's kind of a blessing in disguise. Sometimes you don't realize it in the moment, right? But when you talk about you can get quality companies for 50, 60, 70, 80% discounts and do that over a 12 to 18 month span. That's pretty special, right? That's a very rare opportunity you ever get that. You really have to go back to the last time we really had one of those true opportunities was a great financial crisis. That's the last time. Rona was not that opportunity. Rona was like straight down, straight up. So you never got a long period of time to buy into a lot of companies at discounted rates. You had like 3 months to buy into stocks that were discounted, like basically February through April. And if you weren't in that February through April crowd, you were already starting to pay much elevated prices because the market came back in almost it was like a V-shaped recovery, essentially. It was up almost a straight line. It might even call it a reverse L-shaped recovery or something like that, okay? All right, guys, next one up here. Is a consumer really as strong as Black Friday sales suggest? All righty. And let me know your opinion in the comments section if you have an opinion on that.
Stocks falling hard as COVID protests in China weigh on the markets. The Dow dropping nearly 500 points. The S&P and NASDAQ both falling more than 1.5%. The spread between 2 and 10-year treasuries.
We covered all the China stuff, by the way, on this channel last night, for those that don't know.
Narrowing slightly after crossing the 80 basis point level earlier in the day, a fresh 40-year low. But there were some bright spots in this sea of red. Ulta and Merck both hitting all-time highs during the session. Meantime, Black Friday sales scored a win for retailers, at least on the surface. Online sales a day after Thanksgiving topping $9.1 billion. That's a record, according to Adobe Analytics. But what's that number look like when you account for inflation? Let's bring in Joe Livornia of SMBC Nikko Securities America. He's also the former National Economic Council chief economist. So, Joe, we were talking about this. We're like, oh, on the surface, all the headlines are cheery. The consumer's still strong. Well, when you think about what inflation has done to prices and you think about mentally backing that out, it would seem to me that there should be a decline.
Yes. Well, look, the nominal numbers look okay because the prices are higher. So the units times the higher prices gives you good nominal numbers, the $9 billion. And it may turn out that November consumer spending looks great. And November 2007 looked good. And December 2007 looked good. And it turned out that that was the peak. The economy entered recession in January. There are three factors that are going to hurt consumer spending going forward. Certainly one is higher rates.
Before we get into that, and I want him, this is going to be good here about what he's talking about with the consumer. But I think that was a big subject because some people say, well, inflation 7-8%, numbers only grew, let's say 3%, right? It was a little less than 3%. So maybe it's a 5% decline. Not the way it works. At the end of the day, when you think about, especially a lot of these goods that people are buying on Black Friday, are they cheaper or more expensive this year than last year? Tell me, that 65-inch TV somebody just bought on Black Friday, is that cheaper than last year or more expensive? I almost guarantee you it's massively cheaper. And the same could be said for almost every single good out there. Last year, these retailers didn't need to discount anything. The demand was overwhelming and people were flush with cash. And honestly, they didn't have much inventory, a lot of these retailers, so they try to get top dollar for everything. The sales were almost non-existent last Black Friday, to be honest, okay? And so I can almost guarantee you everything that people got this year was a far better deal than the previous year. So when you're seeing this inflation and all those sorts of things, that matters in many other places of the economy, but not for Black Friday sales. Because I can tell you that coffee maker was cheaper this year than it was last year. That microwave was cheaper this year than it was last year. That's just the way it is. These retailers had way too much inventory and they're much more desperate this year for Black Friday than when they were last year when they could get top dollar. Because last year you could get top dollar for everything. You had a low supply of everything. Your demand was overwhelming and people were flush with cash. It's a very different environment this year.
7 looked good, and it turned out that that was the peak. The economy entered recession in January. There are three factors that are going to hurt consumer spending going forward. Certainly one is higher rates. The change in interest rates has been the largest in 25, 30 years. You look at mortgage rates. Secondly, you still have very high food and energy costs. Headline inflation is running above wage growth. And the third piece, which is important, is wealth. Households are losing in the stock market, they're losing in the bond market, and their home prices are slowing. All three of those factors, Melissa, suggest to me that the economy is going to be a lot weaker next year.
We started to hear from retailers also.
I 100% agree with all those comments. Yep. I mean, think about it. If you own stocks, you're in a worse position now than you were 12 months ago. Unless you're a short seller, that might be a different situation for the small people out there that done that. And if you got in and out of these positions quickly and those sorts of things. So almost everybody's in a worse position, right? And never mind in 2023, if we do get that massive recession, we'll see another massive hit to the indexes that will be much more substantial than this year, especially in regards to S&P 500 and the Dow, which would hurt people's, obviously, portfolios, feeling, confidence even more so. Real estate's just started to get hit. That's going to hit way more in 2023. And as somebody that owns 3 homes, I love it if real estate went up in 2023. Ain't happening. It's going to... And so when you factor all these things in, the consumer's in a worse spot. Crypto? Come on, man. You own crypto. Give me a break, right? So almost no matter what asset you supposedly own, you're in a worse position pretty much, right? And so that's just a huge other factor that he brings up. And obviously inflation, slicing and dicing, we all know that, right? In those sorts of things.
Less of a use on the part of the consumer of debit and cash and more on credit at a time when obviously the rates on credit cards are they were through the roof before, but now even more so. I'm wondering how you factor that in terms of viewing the consumer's health as they lever up in a time when rates are rising still.
Well, they're levering up in part because the average consumer's real wage is declining, and credit cards are an easy way to fund sort of a lifestyle change. People want to get back to normal. I was happy to come into the studio. Hadn't been a long time. Everything has been remote. And people are still, I think of that excess, the vestiges of that excess demand are still there. But at some point, if the economy weakens as I expect and the labor market slows, you'll see credit card debt go up higher as people try to fund that spending a bit longer. But eventually it'll turn down. And the fact that there's been so much debt usage, to me, is a problem. It's not a sign of health.
Yeah, Joe, I appreciate, obviously, you coming on. $5 trillion now consumer debt approaching, if not through it. North of $1 trillion in credit card debt in the United States. I mean, these are astronomical numbers that you still have people come on and talk about the health of the U.S. consumer. What's the disconnect there?
I don't think there's the disconnect so much, Guy. I think that, again, we were coming out of a pandemic and all the lags and the normal relationships have been askew. But I don't see how the consumer, given what I laid out, is going to be able to sustain these rates. If you look at household net wealth through the second quarter.
Before we get into more of this, I think he's bringing out a lot of great points. I'm loving this video so far. I hope you guys are as well. What's so silly about credit cards, okay, is in terms of the credit card companies, they're always pumping out in terms of just ease of access to getting credit cards, credit lines, all that stuff. It's always in the worst time possible when the economy is at its peak and it's about to go down. And so if you experience the economy, or maybe you're watching this and you're younger and you saw your parents go through it or whatever, right? In 2005, 2006, 2007, the amount of credit card offers. I mean, I remember my parents like going to the mailbox, and I remember, picking up the mail. I was in high school at that time. And I remember just credit card offer after credit card offer after credit card offer. And my parents in those days had so many dang credit cards, I couldn't even keep track of them all. It was ridiculous, right? And right now we're going through the same exact thing. Credit card offers are plentiful. It's no problem to get credit. You can get they'll just throw money at you right now. And so people are obviously utilizing that, right? And it's not right, but it's what's happening. It's just bottom line. And then when you go into that, try to get a credit card in 2009 and 2010, 2011. It got very stringent. It got very hard. And it was almost like, a very difficult process. Let's just call it that. And as somebody that tried to get their first credit card, and I think I did get my first credit card in 2009, they hardly gave me any money on that thing. I think I was probably lucky to have a $200, $300 max on my first credit card. And never mind that, the interest rate was I don't know what it was, 22 or 23%. And not only that, but the only one that would even offer me anything was Capital One, because I guess they'll give a credit card to anybody. And so that was a very negative experience for me. And then I got charged some fee or something like that. And then I ended up closing the account and canceling it because I was upset. And I didn't have credit cards for the longest time until I started to realize, you can get the points for it and just pay it off right away. And that took me years to kind of figure out that whole game of just literally just get the points. You get all these points and then just pay it off right away. Just treat it like it's a debit card essentially. Where you're essentially, as soon as you add it up and the points come in, boom, you pay it off. So you never pay an interest, right? But nonetheless, that's not what most people do. What a lot of people do is they get these credit cards, and let's say they get an offer for $10,000. And next thing you know, they got a $7,000, $8,000, $10,000 balance on that. And they don't have the money to pay that off. That just starts accumulating this massive interest. And next thing you know, they're stuck in this debt hole that they never get out of. And it just goes on year after year after year after year in this massive kind of debt-ridden situation.
The Fed's data show over a $6 trillion decline in household net wealth. So you have $6 trillion decline in net wealth, $5 trillion in debt.
$5 trillion increase in debt, $6 trillion down in household wealth. And we haven't even hit a massive recession yet. And that's a big question if we're going to hit that, right? But if we do,
I think the issue, Guy, is that the spending is contemporaneous. It tells you kind of where you are now. It's not forward-looking. If you look at things like consumer sentiment, expectations, which are in the index of leading indicators, those are at recessionary levels. So the question is, how bad is the downturn, not whether we're going to have one.
So, Joe, let me ask you, we accept we're going into a slower economy. What do you think is going to happen to credit quality? Obviously, it gets worse, but how much worse do you think it gets?
I would just correct you, Karen, and say it's going to be a contracting economy.
Oh, there we go. Juicy. You know what? I was so funny because she said, going into a slowing economy, Karen said there. She was just setting up for that. And this guy, he had to ask himself, am I going to go full in here or am I going to chill back a little bit and let that one slide? And he did not let that one slide. He said, we're going into a contracting economy, which for those that don't know, it's negative. you're going into a negative economy where everything is going down. Not like flatlining, not slowing, like slow growth, like literally going down, decline, okay?
Half of the year, we're in a contracting economy where we lose jobs and the unemployment rate goes up. If we look at the Fed Senior Loan Officer survey, we're seeing banks starting to tighten lending standards, both to on the commercial industrial side, the commercial real estate side, and households. So it could get a lot worse. It kind of depends, one, on what happens with food and energy. Do those come down? That will lower inflation. It will add liquidity into the system. It's like a tax cut. That'll help because the Fed then can ease rates as consumers feel more flush. And then what's the Fed's response? Do they actually continue to raise rates and then, importantly, keep rates at a restrictive level? My view is they won't. Jay Powell will flinch. When the labor market weakens, I think they'll fold and fold pretty quickly.
Everybody should hope they fold and fold quickly because if the longer they don't, the more damage that will happen in the economy, the more jobs that will be lost, and ultimately the amount of people on food stamps, government support, government assistance will go up massively, and the economic carnage will be much bigger.
You may have higher long-term inflation, but that'll help risk assets, especially on the credit side, because right now, Karen, we're pulling a significant amount of liquidity out of the market. The balance sheet unwind has just started. The correlation on a change basis between the S&P and the balance sheet is about 94. And right now, based on liquidity trends, S&Ps have not hit their low for the cycle. So to me, there's a lot still that has to come through the system. And as that happens, credit trends will get worse because, as you know, credit and equities tend to be interconnected.
What's the magic number in your view where Jay Powell flinches?
When we start to lose 150, 200,000 jobs a month, when there is, this is a weird way to put it, when there's confidence or concern, rather, the unemployment rate is going to go to 5 and possibly higher. And that could happen with the rate in the low 4s.
He's preaching to the choir, The
job numbers start to show a couple 100,000 loss a month.
Yep.
Joe, good 100%. To see you in person. Thank you.
Thank you for having me. Thank you, everybody.
Joe Livornia. What do you think?
It seems like that's the number. It's the unemployment number. It's the last piece of this whole puzzle. Joe just talked about how we've seen risk assets come down as rates have gone up, what negative wealth effect that's happened here. And I think we're all sitting here waiting. Listen, there is a silver lining scenario where maybe the recession is not that deep and maybe unemployment doesn't go up meaningfully because of some of the issues that we've been dealing with for a while. And immigration is a big part of it. So maybe it is different this time as it relates to the unemployment. But it seems like very likely, he seems very convicted that we are going to see a contraction. So recession is going to come. It just depends how bad it is. And when do risk assets, specifically stocks, start to discount that?
Yeah. Jeff, how did you feel when you saw those Black Friday, Cyber Monday numbers start rolling in? Were you happy that the consumer seemed strong, or did you raise your eyebrow?
It's been an eyebrow raiser, and we've talked about this time and time again. It's the less stuff at higher prices story. You see it all over the place. We looked at a chart related to this months ago, and it looked at nominal sales that were trending higher and real sales that were flat. And now you can see really specific examples of it. You know, Pepsi, I think, is a great example. Overall food and beverage market, you've seen about 14% price hikes. What's Pepsi's revenue growth? About 15%. You see the same thing in Clorox. You even see it in names like Amazon. So I still think you are seeing the less stuff at higher prices, and that's what's driving some of these numbers, and that's why I continue to think.
Yes, but not for Black Friday goods, right? People aren't out there buying 12 packs of Pepsi and cases of bleach on Black Friday. So there's a diversion between those Black Friday numbers and what's actually going on the other, let's call it 364 days of the year.
Some of the discount retailers, I know we're going to talk about Dollar Gen in a second, but that's where I am on the whole consumer story.
Yeah, so, I appreciate that. I thought that was a good video. I loved his points. He was preaching to the choir there. And, man, yeah, just 100%. So love to hear your guys' opinion in the comment section. Thank you, everybody. Subscribe to the channel. I'm glad you guys are enjoying this. 19,500 plus subscribers on the reaction channel. Thank you for being here. Much love as always. And have a great day. Watch some other reactions.